in and said, ah, profit is 18. Which accounting standard is being tested here? For me, that's half the battle. Once you realise it's an intangible asset, which may be held for sale and may have an impairment review, actually those accounting standards are quite gentle to write about. When do we sell the asset? Oh, when was it? After the year end. Oh. If you sell the player after the year end, would you recognise that in this year's profit? No. Do we know an accounting standard that regulates how we account for things that happen after the year end? Yes. I say 10. I say 10 talks about events being adjusting or non-adjusting. And what you're saying is you shouldn't recognise this in profit. So the sale after the year end is a non-adjusting event because it does not provide additional evidence of conditions existing at the year end. So it is after the year end, it is a non-adjusting event. There would be disclosure in the notes. There would be disclosure in the notes. I'm sort of relying on your ability to turn this into short, sharp, simple sentences. You get the idea. This is a 10 marker. And that 10 marker was partly about ISA 38, intangible assets. It was partly about ISA 36, impairment. It was partly about held for sale, IFRS 5. It was partly about ISA 10, post-balance sheet events. Oh my God, I worship your examiner. How clever, how devious, how twisted, how convoluted it is to come up with a scenario which is actually, when you've unpicked it, not too bad. But I know how I felt the first time I read it. Oh, bloody hell, what's going on? Oh, way too much. And then I had to say, let's draw breath. Let's start at the beginning. What is it we're talking about? We're spending money, buying something. Are we paying rent, or are we buying the building? Is it an expense or is it an asset? Oh, it's an asset, yeah, because it lasts for more than 1 year. We get the benefit of them playing for us. So it's an intangible asset, and then you're away. And now that you know it's an intangible asset, you're capitalizing those costs. Yeah? And then when they break a leg, it's an impairment review. And when you look to sell them, it's held for sale. Yeah? So, they can be cracked, but you need some calmness and structure to help your brain think it through. Yeah, we'll look at Part C. We will look at Part C. I mean, there are other questions I want to have a look at, but I think it's quite useful sometimes to look at a whole question. So 2 minutes. Can you have a look at Part C as well, please? Accounting issues buried within the 7 marks. Half the trick is identifying what the accounting issues are. Because I think once you've identified the accounting issue, there's a box that you can open up, there's a file that you can open up, and you can then write something about it. So I don't mind the order in which we address these matters. You've read the information. What accounting issues strike you? The naming rights. So there's one clear issue around the naming rights. So sometimes football stadiums get branded a name or sports stadiums get branded a name. The Emirates Stadium. Yeah, Arsenal's where Arsenal play, isn't it? So we're using the revaluation model. We've been offered 100 million from an airline for the property renaming rights. So would you, if you're revaluing the building, could you take into account the potential? I don't see why not. I don't see why not. So the naming rights I would include as part of the fair value of the property. I would include as part of the fair value of the PPE. So the naming rights, yeah, you're valuing the property on a revaluation basis. So if you do that, you debit the asset, credit equity. Yeah, so that you would recognize in equity, recognize in other components of equity. Okay, so part of that is to do with the naming rights. You know, are they intangible or tangible? I guess maybe they're intangible, but you're revaluing the PPE, so I think you can include it as part of the PPE. What else? What are the other issues involved? Yeah, there is an issue about the related parties. Now, you tend to be a related party when there is control, when there is common control, or where you have significant influence. So without cutting to the chase fairly quickly, there are several circumstances when you are a related party in a group context, in a key management context, in a shareholder context. Key management would include family and friends. Related parties sometimes are individuals, sometimes are companies. So related party transactions are where one of you controls the other, one of you influences the other, or you're both subject to common control. So two subsidiaries are automatically related to their parent because their parent controls them, but two subsidiaries are automatically related to each other because they're subject to common control. Now, just because you share a director in common does not mean to say you are a related party. The director is related to the company, the director is related to the company, the director is related to the company, but just because the two companies have the same director does not automatically mean that those two companies are related parties. So, having two directors in common does not automatically result in related parties. So having two directors in common does not automatically result in related parties. You could debate it further. You could say if they are related parties, they would make disclosures, da-da-da-da-da-da. But on the limited amount of information available, the inference is that MC and the airline are independent companies. They happen to share a director in common, but that doesn't mean to say they are automatically related parties. What's the other issue that is at stake? Provisions. Thank you very much. Provisions. Yeah, provisions. And this is because we could be fined. This is because we could be fined. This is because there is a potential breach of regulations. Now again, I cannot be definitive about the situation here, but there are regulations in place which regulate the financing of clubs, and these regulations prevent capital contributions from a related party. The aim of these is to promote sustainable business models. Sanctions imposed by the regulator would include fines and withholding of prize monies. MC wishes to know, the potential implications of the financial regulations. If they impose the financial regulations, if we become in breach of those regulations, we would have to pay a fine. So the accounting issue is about whether or not we should make a provision. So a provision is a liability of uncertain timing or amount. A provision is a liability of uncertain timing or uncertain amount. And it has to represent a present obligation, which is either legal or constructive. There has to have been a past event. So there has to be a probable outflow, which is capable of reliable measure. So it's a liability of uncertain timing or amount. There's a present obligation which is legal or constructive, where there is a probable outflow of economic benefit, which is capable of reliable measure. Yes or no? Shall we make a provision for the fine? No. Yes or no? What do you think? I don't know. I mean, it's very difficult, isn't it? Because, you've only got such a cartoon, small amount of information. Are we definitely in breach of the regulations? Have they actually started suing us yet? Is there any sum of money that has actually been mentioned? For me, it's very, very difficult to say, yes, we should make a provision, because it's a proposal. So I don't see that we should be making a provision in these circumstances. So because there is no provision, because there is no past event, we are not yet in breach. Even if I'm not even certain we will be in breach, but there's no suggestion that they have actually started to sue us yet. So at best, it's a contingent liability. At best, it's a contingent liability, but I don't even think it's worth disclosing in the notes at this stage. But that's a judgment issue. This is a 25-mark question, 45 minutes. Do you know what? I wish we could have about 2 hours on it, because then you could write a really good answer. There's loads to write. This started off talking about borrowing costs. Then the question got involved in intangibles, got involved in impairment, got involved in held for sale, got involved in provisions, got involved in related parties, post-balance sheet events, OMG. It's a typical past examination question. Sometimes the questions do require some specific technical knowledge. So things like pensions came up last time. Things like deferred tax, things like financial instruments do require some very specific technical knowledge. But often there are questions in the exam which the trick to solving them is having courage. The trick to solving them is being quick-witted. The trick to solving them is having a go. Because there are many questions in the exam which are not technically difficult if you have the right structure, the right mentality. It's 1 mark at a time. He's telling you a piece of information, and normally that information is relevant. In that little 7 marker, what are we going to do with the naming rights? They might fine us. The directors, are they related parties? So it's a style of question which is a bit obscure. When I teach, Today we are doing related parties. Today we are doing provisions. You know? And I don't think I ever teach about naming rights. But what the examiner is able to do is effectively replicate real life. The client turning up to the office doesn't say, please, you know, it gives you a real life situation, and you then are the detective, yeah, having to solve the problem. Fantastic. I think there is going to be a thunderstorm later from the noise that I can hear. Or is that people at the back of the room wanting a break? I don't know. It's coming up to 3:30. I'm going to suggest that we take a break. So yeah, it's 3:30. So let's take a break at this stage. Thank you very much. I kept the notes for Sunday, Monday, and I lent them out. I've got back the notes for Monday, but I can't remember who I lent the notes on Sunday to. And if you borrowed the notes for Sunday that I was my handwritten notes, could you bring them back tomorrow, please? Because someone else wants to borrow them, and that's the sort of way it works. A bit easier. Yeah, thank you. So I don't know who I'm talking to. Yes, you can borrow Monday notes, because Monday notes have been kindly returned to me, so therefore I'm able to return them to you, and then you give them back to me tomorrow, and then if I can loan them something, and then it's the way of the world. Right, we are looking at section B, and the typical section B questions are all over the place. And we've looked at a nice little question called MC, and what it might be constructive for us to do now is to have a look at a nice little question called black cut, and black cut is on page 91. Now this question has been slightly updated or slightly edited, so technically there is no part B, but there is a part A, excuse me, there is a part A, there is a part C, and there is a part D. So there are 3 separate, independent, accounting issues. Discuss how the above events should be accounted for in the financial statements of black cut. So basically the same requirement as before, what is happening in this situation. Now there are 3 separate issues. A is worth 7 marks. A is worth 7 marks. And I would like to be quiet for a good few minutes, because first of all I would like you to read the question, and then I would like you to try and think about the answer plan. Try and compose an answer plan. Try and think about what you would write. Alright? And if you can jot a few things down, that would be constructive, and then I can come round and perhaps have a look and have a conversation with you about the issues that you are considering.